Hello and welcome back, everyone, to the newest installment of the Bull Time Investor. Today, we've got Mr. Scott Hartman with us.
Hey, Corey.
Adam, as usual.
Corey.
And we've got a special guest, Mr. Brian Stutland from Equity Armor Investments.
Hey, guys. Thanks for having me on.
Brian, you want to give us just a brief kind of bio of your background, and then we could kind of get into some questions?
Sure. Yeah. I cut my teeth, basically started trading on the Chicago Board Options Exchange back around 2000. Opened up my own broker dealer and was a market maker on the floor, making options, market making. Specifically, really the VIX futures and options is where we kind of increased our operation, our size, our trading. Spent many years in there up until 2015. When we left the trading floor, and a few years prior to that, we had started our investment advisory firm and really began portfolio managing after that, and really creating some of these volatility strategies, some of these option trading strategies in order to benefit clients and sort of mitigate risk, but allow them to still be able to participate in the upside in this equity market and the bull market that we've seen over the last couple decades here.
Awesome. Well, I appreciate you joining us this morning, Brian. My first question, when I was looking through your bio, you've got a bachelor's degree in chemical engineering and a master's in biomedical engineering. So how the transition then to options trading, how'd that work out?
Yeah. Well, I originally wanted to go to medical school. I even took the MCAT. I was going to maybe even go continue my master's into a PhD in biomedical engineering, possibly. But then I actually got a job offer for traders trading option trading. They were looking for more mathematical problem solving mind mentality. And so I sort of fit that profile. I'd love the energy on the trading floor. I'd always kind of studied the markets on my free time. And once I went down there, I really never looked back. It was like, to me, the job was more like playing a video game in fun than it was feeling like a job. And so I knew this was the right place that I wanted to be. Math, obviously, like high math skills or whatever. And it was kind of just really right up my alley. So got into that and, really kind of took off from there. And then other surprises just about my background. In 2008, I began working with CNBC on their show called Options Action that was offered on Fridays. It was kind of like a segment part of Fast Money. Never even thought I'd be on TV media either.
For
so
sure.
Went from geek engineer to trading on the floor to doing some stuff with CNBC and now social media marketing is blown up everywhere, right? So
For sure.
Try and translate that energy idea about what's going on in the markets along with still doing a portfolio management.
That's awesome.
Awesome. Tell us a bit about Equity Armor Investments. Just how did you get started, and kind of just a bit about kind of, the strategy, the firm.
Yeah, sure. So Equity Armor Investments, we started in 2010. We started taking retail clients initially, and then we really kind of realized our bread and butter was creating portfolio management, trading strategies, private wealth management strategies, solutions. And we, our bread and butter were traders on the floor, right? So trading is really up our alley. And what we wanted to do was offer some solutions that were involved with risk management in a portfolio, but rather work with individual clients. We decided to kind of go the route. We partnered with a firm out on the West Coast, and we helped them raise money for a unit investment trust. They had something called the Baker's Dozen, and it really actually kind of blew up. So we raised a few $1 billion, or help them do that, and we exited that partnership in 2017. So we sold out of that partnership, and then we were like, okay, so after this, how can we sort of redo things, recreate things from the trading floor, from the VIX and volatility perspective. And we became portfolio managers on 2 funds by 2019. one called the Rational Equity Armor Fund, and the other called the Catalyst NASDAQ 100 Hedged Equity Fund. So both these strategies allowed us to own equities so that we could participate in the growth of the market and the economy, but use our VIX and volatility trading strategies and our option trading strategies that we learned in the S&P 500 as well, and employ that together with stocks that we own and give people almost like a hedged equity feel that allows people to kind of stay protected to the wing on big volatile events on the downside, but be a little bit different than what's out there because we own volatility. So many strategies get called away. They sell a call option. They're trying to collect income on option trading strategies. We don't do that. We allow investors to continue to participate on the upside. So we really transformed our firm, a couple iterations and really focusing on our portfolio management now. And we do work with some investment advisors as well. And we still have the business of the retail individual investor as well as a small portion, but really half our business is managing a couple mutual funds.
Okay.
Nice.
What's your firm's core objectives?
Yeah. So I think for us, when we look at the risk in the market and you look at the level of volatility that you see these days, really, I mean, so much transformed. This is just going back to my days as a market maker on the floor, that as things became more electronic, so much of the market moves faster and faster instantaneously. I can remember the days in 2010 on what they called the flash crash when we were trading on the floor and the market, dropped out of nowhere, bids fell out of place. Now, a lot of safeguards are in place now to combat that, but the electronic world of trading has just been such focused on high frequency and movement in the market that you're getting more volatile events than you normally see. I mean, look at what the tariffs did in April and the shock reaction to the market there, and then the bounce back. Look at what happened during COVID. I know that was, sort of a pandemic freak thing that happened. Look at what happened in the credit crisis in 2008. You're getting more and more of these like shock volatility events. And so our focus as a firm is to sort of mitigate that and take that concern out of the marketplace and still be able to participate as an investor and the growth of the world economy, right? And so, we use these option trading and volatility strategies kind of embedded as a core to a lot of our investment strategies, not just a couple of mutual funds that we manage, but when we work with investment advisors, we talk with them about how they're managing things with clients, how they're controlling volatility or owning volatility as an asset class, which a lot of people don't really understand and know how to do. So that's something that we can help provide to people and have an added feel that, helps diversify a portfolio. It's not just relying on stocks and bonds, but by buying volatility itself, most notably the VIX, we're able to sort of own an asset class that most people don't own in a portfolio.
For sure. I have like a kind of maybe more of a behavioral finance kind of question, but what do you think the best piece of advice that you can give in that psychology part, like to our clients and to financial professionals? What do you, I mean, clearly it seems like you're trying to help us mitigate risk and those kind of things, which is great, but how, what's a good piece of advice for us to give to our clients?
Yeah, well, I think one thing to keep in mind, and this is really actually the crux of even our inside of our strategy, is that, we believe the market over time, and the past historical data has shown that the market goes up over time, right? And the S&P has growth returns of anywhere from 8% annualized to very good bull markets of 12 or 13% annualized, right? And so over time, the growth of your investments are going to be there. But now along those way, right, there are bumpy situations, anywhere from credit crises to tariff shocks, like I mentioned, to pandemics, to geopolitical risk, right? All these things add to levels of volatility. They add to levels of nervousness, anxiety by individual investors. And so we want to find ways to really stay in the game. And I think when you speak with advisors as an individual client, right? If I'm working with an investment advisor, I'm thinking, how are you as an advisor finding ways for me to sort of mitigate some of these big drawdowns?
Yeah.
Limit that so that I feel good about staying in the game and really focusing in on my risk tolerance, right? Some people want to take the bigger risk. That's okay. But for those that don't, which is, a majority of investors that have accumulated a lot of wealth, they kind of fall in this moderate conservative sort of range. And
Sure.
I want to speak with an advisor and know that I'm going to stay at that, protected level of interest in the market, but I don't want to get blown out, right? And I want to be able to sleep at night. And that's the key, because, the more times you can be the casino, right? As an investor, if you're making smart decisions for your clients, which, I would tell them that you are, that's why you guys have been so successful, right? Is that, I can be the casino, right? For that individual client, I can be your casino. We just need to keep playing. We need to be able to stay in the game, and look for a diversified strategy to do that. I don't think individuals can do that on their own a lot of times, and they need that help, and that's what investment advisors are for.
Yeah, I think too. Sorry, Adam, just real quick. From a planning standpoint and kind of how we run our practice, it's very risk forward, risk centric as far as, our clients understanding their thoughts on their intrinsic kind of, risk tolerance, and
Sure.
the emotional response triggers. Obviously, we know as advisors, be in the equity markets, stay the course, right? But that conversation from a psychological standpoint and the emotional response of the clients is a bit different. And so we're thankful to, managers like you guys that kind of help us have solutions to help mitigate that for sure.
For sure. When I think a lot of clients feel like they're able to take on more risk and more volatility until the volatility is actually there.
They get punched in the mouth. Yeah.
Emotional fear takes over. And then you have to, then we become the psychologist to try to talk them off the ledge and, remind them of, short-term moves versus long-term goals. So, it's
what I think is so cool out there right now, and that we've seen develop maybe over the last 5 or 10 years, is so many different funds, whether they're actively managed ETFs or mutual funds, now kind of have like this hedge fund liquid alternative wrapper to them.
Yeah.
That allows advisors not to just, be vanilla, buy stocks, buy bonds, and hope bonds appreciate, which, we're now in a time frame where that's not really the case. We're not in a Fed driven, drive interest rates to zero environment, right? So you look at all these other kind of fund asset classes that you can kind of get people into, and it gives them a different sort of risk profile and diversified, right? Because as you build out a liquid alternative sort of little carve out bucket, along with your core holdings, it allows investors to be in these funds with active managers. And when something else is up, this thing might be down a little bit, and when their core equities maybe are down, something else is up, and that kind of helps offset the total portfolio so that they do stay in the game for the long term.
For sure.
Well, just as a pivot, and I'm glad you brought it up. It's fairly timely, obviously, because Chairman Powell spoke yesterday. They're holding tight for now, but hopefully, maybe predicting some cuts in the future. What are your thoughts around Chairman Powell and the Fed right now, and just rates in general, and how it relates to the current kind of economic landscape?
Yeah, I mean, the economy is chugging along. We just got the reading of 3% GDP. Unemployment rate is still sitting, in the 4 handle. So really, in terms of the economy, it's chugging along. And we just got the PCE number this morning that was, actually year over year, 0.1 better than what people expected. So it's still sitting just slightly above that 2% level that the Fed chair mentioned that's their target, to get inflation down to that. So there's still some inflationary pressures. And look, there was a couple people that dissented that are expecting to want to cut come their September meeting, cut interest rates a quarter point. But it seems like the core of what Paul's statement is that, no, we need to kind of hold steady here until we really see that inflation get to that 2% mark. I know the Trump administration has been harping on the fact that we need to cut rates.
Yeah.
And yes, that helps the borrowing of our taxpayer. That helps the government borrow at a lower, cheaper rate. But we can't do that with the risk of printing money and creating inflation. So there's this really delicate balance that needs to sort of take place here. And look, I mean, there have been 7 times, actually, I was looking back, there has been 7 times where the markets were at all-time highs. In other words, like within 1% of their all-time highs, and the Fed cut rates. So it has happened before. It can happen, but I think he wants to see some of these inflationary pressures really start to subside before they go ahead and do that. So it'll be interesting whether they can actually cut come September or not. I know there's two that want to cut, but I'm not certain they really get there until we get some better readings.
So kind of as a follow-up to that question, do you feel that part of the reason why Powell is waiting is he's concerned about maybe tariff impact on inflation and having inflation go back up? And also just your opinion, do you think any of it's like politically related as to why he's wanting to remain constant when you've got, I think the first time ever where two people have dissented and said we need to, kind of gone against the chairman?
Well, I mean, on the political side, it's interesting because when he was speaking to the press yesterday, he did say that, we need to be separated. There shouldn't be political influence. I do kind of find it a little funny because, his predecessor, Janet Yellen, then went to work as Secretary of Treasury for the next administration after that. Right. So, I mean, you wonder how much political, division there can really be. Right.
Right.
Having said that, I think he's done the right thing to hold off on lowering interest rates here, right? Because, like I said, the markets are at all-time highs. We have seen cuts before, but there is still this inflationary thing. I mean, you can't tell me that people's health insurance costs aren't going up, their car insurance, their cost of housing, et cetera, et cetera. The real things that actually hit people's pocketbooks, I think, are still being felt, right? And so, I don't think it's unusual that he's sort of holding back, whether you want to call it political or not, or whatever. Hopefully he's making the right decision. Now, I thought he was terrible in 2021 in waiting so long to raise rates through 2022. I thought that should have happened a lot faster.
For sure.
So I think he's maybe a little too academic sometimes in that sense. And I'd like him to be a little bit more predictive of where the car is going on the highway, not just looking out the rearview mirror and analyzing it from data that they saw. Maybe take some steps and seeing where things are going forward.
To kind of piggyback off your point of inflation and kind of cost of goods and stuff, what from a consumer spending standpoint, the most recent reports look like it's trending a bit downward. I mean, what do you think that the implications of that would be more on the broader market space?
Yeah, I mean, I think because you also brought up tariffs too, like in terms of the consumer, I do think some of these consumer discretionary stocks out there, we got reports from Tesla just had earnings and sort of weaker revenue or income on the auto sales front. We saw Chipotle a little bit weak. We've seen a couple other consumer discretionary kind of names come in a little bit weaker. In fact, if you looked at XLY, which tracks an ETF that tracks the consumer discretionary stocks, it's actually only up a little bit on the year, where the rest of the market a lot of the gains are coming out of NASDAQ-y, AI kind of tech kind of play names, not the consumer, right? And so I do think the consumer is struggling a little bit. And I think these companies are struggling. You see these tariffs hit, they're struggling to actually really increase pricing power so much that their profit margin's actually getting shrunk a little bit. So, that in terms of tariffs being this inflation shock, I don't know how much it really is. And if it is, it's a one-time shock. It's like a company that reports earnings and they say, we're going to take this one-time charge, and then after that, we're going to be okay. Yes, the stock gets hit, the market maybe feels it, the consumer discretionary stocks will feel it, but I feel like any tariff shock is sort of a one-time little bit. And I don't know how much price increases can really come from that, because the marketplace is the current marketplace right now. Prices are where they're at because that's where supply and demand have met each other, and that's where demand is being met. So you start to raise prices, you lose demand. That's why I think with the tariff shock in April, when people are like, whoa, tariffs could go to here, at 30% or more, that would have killed demand. Right. And I think that's why the market freaked out. And then, we've had to kind of draw that back. So I think we're finding a nice happy medium in terms of that.
What, I guess just going off of that, then I know you don't probably not into forecasting, but just as the general overall market outlook from a forecast standpoint, what are you guys seeing? Kind of what are you guys telling advisors and telling the PMs and stuff on the floor? Is there any specific like sentiment that it's like, we think we're still in the midst of a secular bull market, or we're poised for a pullback, or what are your thoughts on that?
Yeah, I mean, look, I think there are a lot of similarities of sort of the mid to late 90s feel to the stock market. I started trading on the floor in 98, and when I walked on the floor as a clerk, the first half of 1998, it was like every day felt like the market was up every day. It's like, does the market ever go down? You just buy some out of the money calls or get long stocks and you're good to go. And then the Russian debt crisis and long-term capital management hit in late 98, and we had a big blip in the market. But I do feel it's pretty similar to that. And I feel like the blip, that long-term capital management, the Russian debt crisis that occurred in 98, I kind of liken that to the tariff shock that we had in April, where, the market took a hard hit and it sort of shook that off and then started moving higher. I feel like we're maybe in this 98, 99 euphoria where AI, we're undergoing this technology revolution right now. It's going to change the game in a lot of industries. It's going to make a lot of industries a lot more efficient. It's also going to take jobs away from people potentially. Nobody knows what's going to happen there, but this tech revolution was the same kind of revolution you saw in the late 90s. And I think there's a lot of similarities there. Now, are we in, inning number 3 in this, or are we starting to get towards in terms of valuations of the market? We're probably in inning number 2 or 3 in terms of the technology revolution of AI. But in terms of valuation, we may be in that like middle, 5th, 6th inning now, where I think there's still some more to go for another, 6 to 9 months before we get some sort of, big kind of volatility washout.
Yeah, it's interesting you say that, because I mean, just following trends, right? I mean, it felt like the market was getting, since the recession, right, kind of getting a little bit along in the tooth, and then we've had some geopolitical events, and then obviously we went through COVID, and then obviously the interest rates and inflation peak, and then it felt like, all right, man, we're really slowing down here, losing a lot of steam, and then bam, you got this kind of new tech revolution in the AI space, and as we're recording right now, you've got Meta and Microsoft just blowing out earnings, and the Nasdaq's just popping like crazy. So it is interesting, and I feel like it's almost like, I don't even know if it's a second wind, it might be a third wind or a fourth wind in this this run up here, but it'll be interesting to see how it plays out for sure.
We got earnings from Meta. Looking at the stock up over 10% today. Microsoft earnings were phenomenal. So these couple leaders, NVIDIA, Microsoft, Meta, just really have been the Amazon in it to some degree. I think Google's lacked a little bit, Alphabet in this. I think people are worried about their search engine capabilities and whether that part of their business will get hit. So it would almost be like the Yellow Pages was, when search became a thing, versus how search is going to happen in the AI world. But some of these names are really just, blown out in earnings and move to the upside. And I think that's why you're seeing the NASDAQ 100, for example, be up over 10% basically since the end of May. So, if the market was down and back up April, May, since then, really these high flying AI play kind of names have really taken off and continue to show earnings growth and the ability to do that going forward too.
Awesome. So you liken this market to the late 90s, 98, 99. So in the early 2000s, we also had that tech bubble burst that caused a big downturn. And we're obviously seeing tech be the leader, AI be the leader of growth in the markets really over the last 3 to 4 years. Do you see a point in what would be that catalyst to where we see that slowdown in AI and tech, and the rest of the market kind of catches up to that?
Yeah, I think there's still some more to go on this. So I think there's some upside. Like if I was looking at levels like in the S&P, like valuations would have to get a lot higher. Even a name like NVIDIA, which is basically, maybe the epitome of the AI high flyer. If you look at their forward PE and where they've guided towards future earnings, it's not that outrageous, really, actually.
Right.
So it's a question of kind of like you mentioned, Adam, is there going to be any kind of slowdown in some of this growth? And will that start to, pop the bubble? Or will the Fed, now remember in 99, 2000, the Fed actually raised interest rates basically when you saw this huge, kind of bubbly, frothy kind of market, and that sort of popped the bubble. So I think something like that, where you see something in the credit market, something in interest rates that end up bursting the bubble, rather than otherwise. I think this can kind of continue to go, and these guys are gonna be the leader. I mean, all this stuff is so revolutionary.
I have one last artificial intelligence question. How do you how do you see that impacting your business? Like that's here in like you're probably using some now, I'm assuming, and then like how do you see that in the the next 6 months and then maybe a couple years out? Like what does that look like for you?
I think more and more firms like yourselves are going to have to try and figure out ways to sort of incorporate some of the artificial intelligence in their day-to-day business, and can use things to help make their business, far more efficient. Where before in the past, maybe an investment advisory firm would have needed 15 to 20 people. You've got compliance, you've got trade checkers, you've got admins and whatnot. And I think a lot of that can kind of get cut out. And done by it. In fact, the other day, I literally spent 30 minutes talking with Grok back and forth about different ways to like load positions up and write code in Python for me. It was wild, and I
just got it my Tesla last night, so just up.
Yeah, right.
yeah, it's great.
That's very cool. You can sit there on your commutes to work, and
you got it.
Grok now and brainstorm ideas, right?
You got it.
Yeah. So all this is going to be, revolutionary. And it's going to make advisory businesses probably more efficient, along with other areas. And you've got to kind of figure out how to use it.
Awesome. Well, Brian, we really appreciate you joining us today. We really appreciate the partnership with Equity Armor, and obviously giving us a solution for our clients to help kind of mitigate market fluctuations and risk tolerance while still being, equity forward and equity centric, which I'll speak for Adam and Scott. We're a firm believer in too. So
for sure.
Really appreciate all you do. And thanks for joining us today. And thanks for joining the Bull Time Investor. Till next time, guys, take care.
Thanks, Brian.
Thank you.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.